This is the first part of Lecture 3, the lecture about the stock exchanges and alternative trading systems. And I'm going to give about half of this, post it immediately, and then in class tomorrow, on Wednesday, give the second half in the class. So we'll do this periodically in order to make up for lost time, or in some cases to add a little more elaborate description of things that we don't have time to do in the classroom. But let's try to get this out in less than half an hour because these videos are harder to watch than lectures are. And I'd like to try to limit them to less than half an hour. So we're going to start by talking about the distinction between listing and trading your stocks. We've already talked about IPOs and how they work. And when you do an IPO, that's effectively the act of listing your stock. As soon as you see your stock trading as an IPO, then it's listed. Now, generally here in the United States, for at least the sort of quality stocks that we trade, the listing is either going to be done by the New York Stock Exchange or Nasdaq, or in some cases both, because some stocks these days are listed on both exchanges. There is the possibility of listing on the over-the-counter markets, but we don't talk much about those kinds of stocks because the standards for listing for them is not high enough. Now, traditionally, it would be the case back in the 80s and 90s or so that if you listed a stock on the New York Stock Exchange, that stock would thereafter be traded on the New York Stock Exchange. And the same with Nasdaq. If it was a Nasdaq listed stock, it would also be a Nasdaq traded stock. But that relationship is broken down. Although you may list on the New York Stock Exchange and not on the Nasdaq, once the stock is IPO'd, it can be traded on any exchange, such as those that are listed here and those that we'll talk about today. The New York Stock Exchange ARCA, for example, as we'll see, is the electronic exchange for the New York Stock Exchange. Nasdaq on IEX, I should say, plus regional exchanges and even off exchanges, as we're going to see. So we're going to mostly try to describe in this lecture the exchange structure, how it's changed over time and how it works now. And we'll conclude with a summary. And then when we come back to class on Thursday, we'll pick up this lecture on the subject of what are called dark pools. So in this lecture, we don't talk about dark pools. We end just as we get to dark pools. Now, in 1998, some laws were passed that identified these electronic communications networks that are referred to in the book as ECNs. And the law was called Reg ATS, and the ATS stood for Alternative Trading Systems. It was becoming clear by 1998 that the open outcry style of exchange was going to be replaced eventually by fully electronic exchanges because they're quicker and they cost a lot less to execute a trade. And the handwriting was on the wall. As it says in the book, overseas, like in Singapore, for example, these exchanges had already been operating for a period of time, the electronic exchanges, and they were clearly successful. So the decision was made to kind of regulate this process, so this law was passed. And the law authorized fully electronic trading and clearing networks so that you can use them. Most of them at the time, there were some that already existed, were independent. And as they were developed, they were designed to compete with Nasdaq and the New York Stock Exchange, such as Instinet, for example, which had been around for a very long time, and Archipelago and the Island. But most of those really, in fact, all of them either became absorbed or they merged with each other and then became absorbed by the large exchanges. But there was a period of time in the early 2000s where there were exchanges with names like the Island, Archipelago, and the like that actually offered substitute options for trading stocks. Now, the oldest was Instinet, which dates clear back to 1960, and they specialized in large institutional trades or big block trades. The term big block normally refers to a trade where a single trade is 10,000 shares or larger. And so, of course, there you're talking about institutional traders like mutual funds and pensions that have the need to trade stocks in very large volume. So Internet was a very early and very advanced electronic exchange that allowed these large block trades. Some of the new ECNs, the electronic communications networks, that's what they were called, began to specialize in after-hours trading, and that's talked about more in the chapter than I talk about here. Normal trading hours for us are 9:30 to 4 o'clock New York time, or 6:30 to 1 o'clock out here on the West Coast. So after-hours trades refers to trades that are either before that period of time, before they open, or after that period of time. And how that works is discussed in the chapter and not so much here. But the primary purpose for these ECNs is that they introduce low latency, fully automated, computerized trading in place of the old-fashioned human-based open outcry system. Now, this was refined in 2005 by the game-changing mandate, as I say, that was referred to as Reg NMS. Remember in the class that I was describing the difficulty of getting limit orders arranged so that they appear at the proper place in the queue. And of course, the very best of the bids should become best bid for the national market, and the very best of the offers should become best ask for the market. And so the effort to set up a structure where this worked well was governed in part by Reg NMS, which stands for National Market System. And its feature was to consolidate the tape for all exchanges. And the tape is in reference to the flow of the bid-ask queue for limit orders for the largest part. I guess the tape also includes market orders, but they vanish almost as soon as they appear because, of course, they're executed immediately. So the consolidated tape for all exchanges meant that somehow all this data from individual exchanges had to be available for everybody, including the small retail trader, if you're willing to pay for the data access. As I said, that's actually quite expensive if you have all of the data access you might need. I pay, sometimes I think more than $100 a month for what I need from Interactive Brokers. But you can trade without all of that data access. You don't need it all. Rule 611 said that this system has to be designed such that the orders trade at the best possible price, and that was at the time defined to be the NBBO system. And what that means really mostly is if you submit a market order, whoever you submit it to is supposed to make sure that you get it if you're trying to buy something at best ask, and if you're trying to sell something at best bid. So let's see, do I have that right? I sometimes say that backward. Let me make sure mentally that I have that right. Let's see, best bid is placed, of course, if you are making an offer to buy. So if you are trying to sell something with a market order, you have to get that at best bid. So that's what Rule 611 says. You should have no reservations about getting the best price for your market orders. And then standardized trading rules were adopted that were simply slight modifications of rules that had been around for a long time, and they had to be followed. And then Rule 610 says everybody gets to have equal access to the market. And despite all the criticism you read of the stock markets, Rule 610 actually has been, I think, fairly applied. I think retail investors get a pretty good deal in the stock market these days. So, given the new rules, what precisely is a stock exchange? There's somewhere between 5,000 and 6,000 stocks that are traded on listed exchanges in the United States. This is older data. I couldn't find it for 2019. According to the rules that I just outlined, a stock exchange is any electronic network or physical exchange, including the old outcry systems, because they still do exist. The New York Stock Exchange has one. Any system that adopts its rules for itself that comply with the requirements of Reg NMS. So to become an exchange, you have to go read Reg NMS, and you have to certify to the Securities and Exchange Commission and to other private agencies that you will follow the rules, and you have to demonstrate how it is that you would follow those rules. And the technology used by the exchange, for example, must include order routing and must be capable of ensuring the compliance. So you have to lay out, in other words, how your technology is going to ensure that your customers get the best price. Now, when one says, well, how many exchanges are there in the United States? That's kind of a sad story, actually. I could have said here there are 2, New York Stock Exchange and Nasdaq. Here I have 4, but when we look at the market share, most of the market share goes to the New York Stock Exchange and Nasdaq, and the 2 bottom ones, CBOE, BATS Global, has a very tiny market share, bigger though than IEX, and IEX has a very small market share, as we're going to see. Now, I think it was thought that Reg NMS would create 4, 5, 6, or 7 regional exchanges or electronic exchanges that are national that would begin to compete with each other, and so none would really dominate like the New York Stock Exchange or Nasdaq. And that kind of happened for a while. There were exchanges like BATS, BATS Global, Edge, Edge A, and as I said, Instanet. But ultimately, mergers and acquisitions reduced all of that back down to the status quo, where effectively there's really only 2 large exchanges, the New York Stock Exchange and Nasdaq. The New York Stock Exchange, as we'll see, has a physical and electronic component. Nasdaq has always been electronic. So really there's 2, like I say right here, even though technically there's 4 or 5 or 6, depending on where you draw the line. But let's talk about the 2 big ones. Most of your orders, maybe every order you ever make in your life, is going to be routed to one of these 2. First, the New York Stock Exchange has 3 exchanges within it. The first is the New York Stock Exchange floor, and a lot of people don't realize that this still exists. But when you see these pictures, like I'm showing here at the bottom, of people standing on a floor around trading booths making orders, that still does happen on the New York Stock Exchange floor. That's the way it all looked back in the 1960s and 70s. That is a traditional physical exchange that takes place on the floor. It's partially electronic. It's a sort of hybridized electronic that has a much larger electronic component in it than it did in the 80s and 90s, but there are people still on the floor using open outcry methods. And on busy days and on the market open, that physical exchange still gets quite a bit of activity and at times can account for 25% of total volume for certain times of the day. The real New York Stock Exchange, though, that you would submit most of your orders to, or your broker would submit to, is New York Stock Exchange ARCA. And that was the result of the New York Stock Exchange purchase of Archipelago, the ECN, one of the originally independent ECNs that was supposed to compete with the New York Stock Exchange, but instead it became part of the New York Stock Exchange. It is now called ARCA because it was acquired in 2005. And then there's also a sub-exchange called New York Stock Exchange Market, which is dedicated to listing and trading small-cap stocks. So as far as you're concerned, you don't really need to know any of this if you're going to trade stocks, because again, as I explained in the last lecture, you submit your limit order or market order to your broker, and you normally choose by default the trading option that is referred to as SMART, and that gives your broker the right to route that order anywhere the broker thinks will serve your interest. And it may go to the New York Stock Exchange, it may go to Nasdaq, you will probably never know. You can, though, on the other hand, sometimes tell your broker where you want to route your order if you have some reason for doing that, and normally you would not, given that the PBO is supposed to guarantee you get the highest price no matter where you go if you're trying to buy, for example. But you can if you have some reason for doing it. If you do, by the way, often the transaction fee for doing it is much, much higher than it would be if you simply routed it as a so-called SMART order. Again, the term smart means let the broker figure out where it's going to go. Now, the New York Stock Exchange is actually owned by the International Exchange, ICE, and was bought in 2013. They retain their physical exchange on One Wall Street. That's now mostly kind of a museum and a media place where you go. Most of the actual trading that takes place on the New York Stock Exchange happens on a restricted electronic exchange in New Jersey. It is the oldest and the most traditional of the U.S. exchanges, started in 1792, so it really has a long history. And they originated the open outcry system that is discussed more at length in the chapter, and that's where people stand around in large groups around a horseshoe-shaped booth, and they make hand signals and scream and yell orders and so forth. There's not much of that anymore, and even the floor trading today is very quiet on the New York Stock Exchange compared to the historical past. But of course, they had to convert to pure electronic because of the cost. It's much cheaper to let computers figure out how the limit orders are going to be queued and what the significance of it all is. But I do point out that New York Stock Exchange floor, which is still the old physical style human-based exchange, is still important in opening and closing auctions, especially closing auctions, figuring out what price to finally close at. And so that matters. Also, they are often used on troubling days when people don't trust the exchanges because of extreme volatility, and they can be used at times when there is simply a great deal of volatility or bad news, and for large block trades. Large block trades, as we'll see later, have a lot of different options for their routing. They merged with Euronext in 2007, and with that it became an international exchange. And Euronext itself was the consequences of merging Amsterdam, Brussels, and the Paris bourses, and that happened in 2000. Then they acquired the London derivatives market and the Portuguese exchange, and then all of this was bought up by the Intercontinental Exchange in 2013, which is simply a very, very large holding company that actually began as a natural gas trading subsidiary and the like. So New York Stock Exchange opens stocks with the result of an electronic auction, and New York Stock Exchange ARCA is just like Nasdaq in that it is an electronic exchange. And again, if you're like a computer science major or someone who codes a lot, what you need to visualize on how this might work is how limit orders are placed in the queue and how the queue is managed as orders are taken off the top by market orders or by being matched with other limit orders. And for the largest part, that is the arrangement that assures the national best price for both buying and selling. Now, Nasdaq is referred to as Nasdaq OMX. Typically, that's the version of Nasdaq that your order is likely to go through. Nasdaq is an acronym for National Association of Security Dealers Active Quotation System, and that last two terms, AQ, Active Quotation System, sort of tells you what Nasdaq is all about. The Nasdaq is no longer associated with the National Association of Securities Dealers. They broke that relationship off a long time ago. The system was a very, very early, extremely well-functioning electronic exchange developed in 1971. And technologically, it was kind of like a dedicated internet, where the only information that went across the internet, the Nasdaq Active Quotation System, was simply cryptic information about stock bids, asks, closes, and trades. And so brokerage offices around the United States had Nasdaq terminals, and they were monochrome terminals that simply had this kind of information, but brokers could look up the bid and the ask, and to some extent, I presume, I'm not sure about this, the level 2 for bids and asks for Nasdaq listed stocks. And therefore, if you made an order through your broker by telephone or in the office, which is how it was done back in the 70s and early 80s, even the late 80s, I guess, then they used this computerized internet style system that was linked to some very expensive and very large computers in Trumbull, Connecticut. And so it was sort of a very early technology that aped what the internet was later able to do. Now, 3,900 or so companies are listed on Nasdaq OMX in 50 countries and about 3,000 in the United States. That number varies all the time, so it may be off by a couple of hundred right now. The INET, which was Instinet, the global high-speed trading platform, was acquired in 2007, and that helped Nasdaq change their technology to be more in compliance with the 2005 rules. And now Nasdaq listing and trading are entirely separate functions. As I said at the beginning of the lecture, you still list either as a Nasdaq stock or as a New York Stock Exchange on your IPO, and the largest companies are able to actually list as both, although that's still fairly rare. But trading is simply where your broker routes the order. And Nasdaq, of course, is still a huge player. They and the New York Stock Exchange pretty much still dominate the market, but now the market is more chopped up. This next slide is kind of mysterious. You say, well, why do you have a slide with a red line through it? That's because I sort of wistfully want to remind you that the intent of Reg NMS and related legislation was to encourage a whole bunch of these ECNs to develop independently and provide more competition for stock orders. And so this is an old slide where I described how they worked. And BATS Exchange and Direct Edge and all of those began to appear. Instinet was already there. But then they both, as I say here, they both expired at SEC Reg NMS. And then BATS bought Direct Edge, and Direct Edge expanded to B-Tape and so forth, on and on. None of this is relevant anymore because all of these independent exchanges were bought by either the big two, or if you include the Chicago Board Options Exchange, they purchased BATS. CBOE is in Chicago. It competes at a small level with New York Stock Exchange and Nasdaq, but their primary operation, I should say, is in option shares. When we take a look at the market share now, well, this is December 2018, you can see that New York Stock Exchange is the largest with 25%. Nasdaq is not far behind with 20%. CBOE is actually impressive with 17.4%. Again, they managed to accomplish that by buying BATS. BATS was a stock exchange. CBOE, as the name implies, Chicago Board Options Exchange, was an options exchange that buys and sells put and call options. And so they expanded to the stock business by buying BATS. And now they're nearly as large as Nasdaq. And then IEX, which was made famous by the book The Flash Boys, if you're familiar with that book, is a competitor that nonetheless only picks up 2.5% market share. And it may be the case, actually, that IEX will vanish from the scene because they may be acquired by one of these big three. They don't really have enough market share to survive. But you'll also notice that the biggest chunk of all goes to what is referred to as off-exchange. Now, when we talk about off-exchange, we'll have to keep coming back to the subject because off-exchange is quite complicated. It does mean that your order was submitted and executed, and it never was routed to any exchange. It was transacted entirely off-exchange with the promise that you still got the best price that you could get, with the promise that probably is being kept in most places. Now, so that you not be utterly confused about what this means, I'll say a little bit about what off-exchange refers to or might refer to, but not explain it in full. We're going to have to take a look at it in more detail to understand it, and that has to be something we go slow on. Part of this is what we'll later refer to as dark pools. And these are specialized exchanges that trade without listing. They're limit orders and the like. And there's a separate section of the lecture dedicated to dark pools, which is how, in fact, we'll begin the in-class lecture after you've seen this lecture. And then finally, it is possible for the brokers to trade among themselves. And there's a great deal of that. If, for example, you're trying to buy Tesla through Interactive Brokers, and someone else is trying to sell Tesla through Interactive Brokers, there's nothing illegal about Interactive Brokers lining up those two trades and executing it without ever sending it to an exchange, so long as you can assure that the people involved got the best price. You can do it for market orders and you can do it for limit orders. So brokerage houses, of course, simply maintain relationships within their own structure that allow a large number of trades to take place. And of course, they make a little bit more money when they're able to do it that way. There are other arrangements where they can send it to market makers without sending it to an exchange, or they can send it to specialized traders without sending it to an exchange. And so long as they guarantee you get the prices just as good as the price you would have received had you sent it to an exchange, they're allowed to do this. So that generates this big lump all category here as off exchange. So, and again, it's the largest component. It explains more than a third of the entire market. So when someone tells you, yeah, you submit your order to your broker sends it to an exchange, the exchange executes that, it's likely, 2/3 likelihood or probability it's going to happen that way, but there's more than a 1/3 possibility that it actually didn't happen that way. You submitted your order to TD Ameritrade, and TD Ameritrade traded it internally with someone who had a counter offer that matched your order. And that's going to be recorded again as off exchange. Now, as we start to look at this structurally, we have the exchanges, like we said, that are easy to understand. New York Stock Exchange and Nasdaq, and the CBOE BATS Exchange and IEX, and we saw the share that they each have. But according to the law, ECNs are allowed to trade so long as they comply with the regulations we discussed in the opening of the lecture. And so some of these ECNs, they're also called alternative trading systems, or ATSs, exist out there and handle some of the trades. Some of them are what are called dark pools, which means they meet a separate set of requirements to be classified as a dark pool. Well, actually, it's not the case that you're classified as a dark pool. That's an external term that we use to describe what it is. They're classified as alternative trading systems that comply with the law. And given how they trade, we classify them as dark pools. They need an explanation all by themselves, and the lecture in the classroom will be an effort to explain how these dark pools work. So ECNs allow in-house client clearing, as I've just explained a moment ago, whether it's brokerage or a special ECN style institution. Remember, ECNs are authorized as an experiment to become an exchange, and so they're still around, is what we're saying. And they can clear clients' orders inside. Dark pools, which we're going to explain, also process trades, and they are largely designed to do large block client clearing, but actually they don't do that all that much. And we'll explain that when we get to dark pools. And part, though, of the reason that these entities still exist is because of the need to break large orders into small orders. So when you look at the number of trading systems out there, and you say, that's not 3 or 4, it's like 12 or 13, you're counting ECNs. Most of those ECNs do not have a lot of trading volume. As we said, most of the trading volume for specific entities will be New York Stock Exchange, Nasdaq, and CBOE BATS. But these ECNs, these little trading organizations, compared to, say, the New York Stock Exchange, partly make up that 34% of other exchanges or outside trading. Part of the reason they exist, again, is because there's a special problem that arises for large orders, and that's why some of them are still around. So let's explain that, and that will allow us to end this lecture as a setup to going into the in-class lecture where we talk about dark pools. Okay, we're going to end with this slide here. This has gone long enough, I think. This is a good experiment in doing a setup for a more substantive lecture. A big problem that we have to face in these markets is the problem of how you take care of really large trades, where the pension fund or the institutional investor doesn't need to sell 100 or 200 shares of General Motors. They need to sell 40,000 shares of General Motors. As we'll see when we get to mutual funds and ETFs, those enormous mutual funds and ETFs, if they're representing indexes in the sense that the Vanguard mutual fund represents the S&P 500 and the tracking stock SPY, that's the trading symbol, represents the S&P 500. When companies join or leave those indexes, like a company joining the S&P 500 or leaving the S&P 500, those big index funds have to either add substantial inventory to their enormous portfolio or they have to get rid of it, as an example of why large trades exist. They may have millions of shares that they have to get rid of, or they may have a market for a few million shares to add a stock to their portfolio. The problem with having to trade on that scale, as this points out here, is if we know that they're going to have to buy or sell something on that volume, we can front run the market and trade in front of them. Say, for example, you know that someone out there, a large pension fund, for some reason wants to sell 10 million shares of General Motors. That's going to happen. They've effectively announced internally, but not externally, that they're going to do this. Well, if they're going to sell 10,000 shares of General Motors, we might want to short it because, of course, that huge level of supply or demand on an individual stock has what we call market impact. And so large trades have market impact. Now I'll read what I say here, or have written here. Large institutional traders want to trade huge blocks of stock over a short period of time, but they want to do it anonymously because if the market knew their intentions, traders could game the transaction. They want to trade without having market impact, without people knowing what market impact is. So the markets has to provide liquidity to those traders somehow. They have to get the stock out there and try to keep it a secret. Now, for decades, in fact, I'm sure more than 100 years, one of the methods for doing this is to simply take these enormous orders when they're submitted to these ECNs and they break them down into much, much smaller transactions and over time, say, leak them out to the market, hoping that no one will notice. So, of course, you can buy or sell 100,000 shares or 1,000,000 shares. I noticed, by the way, in the slide that I got 100, comma 4 zeros. I'm not quite sure what that number is. I guess that was supposed to be 100,000 or maybe 10 million. I'm not sure. You can sell 10 million shares. You can sell that 100,000 shares at a time, or you can sell a 100,000 share order 500 shares at a time. But of course, that takes time to do. In some cases, these traders want to shop around and see if they can find someone else who's trying to make the opposing trade for a very large volume. Ideally, if I'm trying to sell 300,000 shares, maybe I can find someone who wants to buy at 300,000 shares. And if we do that, we might agree to simply do it at the market. We might say, okay, let's take best bid and best ask and calculate what is called the peg, which is the price exactly between the two, and we'll trade at that price. Do you agree? And if both parties agree, then of your 300,000 shares you're trying to unload or buy, 100,000 is taken care of right there. At any rate, a series of institutions exist to try to mitigate the impact of, or the market impact of large trades. Dark pools are designed for that purpose, and that's why they exist. So when we come back to class and I give the in-class lecture, then we'll begin by talking about dark pools. But here we're just introducing the notion that somehow we have to account for market impact. This is one of the reasons why sometimes I argue that retail traders actually get a break in these markets. It's the really large traders sometimes that have problems because their trades are so huge. By necessity, they're so huge that the trading can actually work against them. If you're trying to unload an enormous block of General Motors, then the very fact that you're trying to do that can drive the price of General Motors down, and that of course works against your interests if you're a pension fund or if you're a mutual fund trying to protect the rights of your investors. If you're a small retail trader and you get some sense that this is happening, you might actually take advantage of it. So we'll conclude with that and come back in class and pick this up with an explanation of dark pools.